Today we are going to continue with our topic on foreign exchange exposure risk management, and we'll also cover the international financial management for revision of the CA final classes. We have just to have a recap, in the last session we had discussed about foreign exchange concepts as well as the hedging techniques of forward contracts, future contracts, options, and money market hedge. Today, we'll take up the example or a case scenario, which is based on the options. XYZ Limited is a US firm. This requires 300,000 pounds in next 180 days. So it's a US firm which requires 300,000 pounds. So it requires pounds in UK currency. And it is evaluating different strategies to hedge against the exchange currency risk. The available market data is follows. The current spot rate for £1 is $2, and 180-day forward rate, £1 is available for $1.96. It means that the price of the dollar has come down and pound is depreciating. The interest rates in UK for 180 days is for deposit 4.5%, for borrowing 5%. In US, it is 5% for the deposit and 5.5% for the borrowing rate. So we see that the rates in UK are less as compared to US. The option contract says the call option is available on pounds. So it requires pounds and call options are available on pounds. Call options gives you the right to buy. And that is what is required by the XYZ Limited to buy or to ask the pounds. The call option, which is available on pounds, is expiring in 180 days, which has an exercise price of $1.97. So if the call option buyer wants, it can buy £1 at $1.97. For this, it has to pay a premium of $0.04. XYZ Limited has also forecasted the probabilities for spot rates after 180 days as follows. The spot rate could be 1.91, which has a probability of 0.25. It could be 1.95 with a probability of 0.60, or it could be $2.05 with the probability of 0.15. So from the above information given above, you have to calculate or choose the correct answer for the following multiple choice question. All right. So we have to buy 300,000 pounds firstly, and that is required in 180 days. So we can use money market hedge, we can use the options here, we can use the forward rate. So three strategies for hedging are available here. If you look at the forward rate, it's directly calculated. So 300,000 pounds would be available at the rate of 1.96. That means under the forward cover, you have to pay exactly 5,88,000 US dollars. If you look at the money market hedge, we have seen that under the money market hedge, here we have payables. So we have a liability, therefore we must create an asset. To create an asset, you will have to invest, right? So what is the rule here? We require 300,000 pounds. So if we invest in such a way that we have exactly 300,000 pounds receivable after 180 days. So we will invest the present value of 300,000 pounds in UK. The deposit rate in UK is 4.5% for 180 days. It's not per annum, it's for 180 days. So you will invest 300,000 pounds divided by 1.045, and you end up getting investment required would be 2,87,081.34. So you need to invest these many pounds. So how will you get these pounds? By using the current spot rate as the exchange rate. So you will need $2 for every pound, which means this figure into 2. You need dollars 5,74,162.68. You will need these many dollars today to be able to convert it into 2,87,081 pounds, which you will invest in UK. So this dollars will come from the US market at the borrowing rate 5.5%. So this you have borrowed. Now what will happen after 180 days? You will repay 5,74,162.68 at the rate of 5.5%. So together with interest, if this figure is multiplied by 1.055, you end up getting 6,05,741 or 40, we can round off $42. So after exactly 6 months, you will have to repay these dollars. So the total outflow will be $6,05,742. So what is happening here in money market hedge? First, you see that you have the pounds payables, which is a liability. So you create an asset by investing the present value of 300,000 pounds in UK. So the present value of 300,000 pounds at 4.5% comes out to be 2,87,081 pounds. And this, how will you get these many pounds? By buying at the spot rate. So for this, you will need 5,74,162.68. Where will they come from? This you will borrow from the US at 5.5%. So once you borrow $5,74,162, this has to be repaid after 180 days, and the total dollar outflow will be 6,05,742 rounded off. So in forward, your outflow was 588, but in money market hedge, the outflow is 6,05,742. The third hedging option that we have is using the derivatives of option. So if you use the option, firstly, we have to see whether the option is exercisable or not. Call options are exercisable when the price of the option is more than the spot price is more than the exercise price. Our exercise price is $1.97. It gives us the option to buy 1.97. So XYZ Limited can buy the pounds at $1.97. But if it is available in the market at 1.91, the call option is not going to be exercised. If it is available in the market at 1.95, call option will not be exercised and I will not buy it for 1.97. So no call option. But if the dollar moves to the pound moves to $2.05, 1 pound is $2.05, which is more than the exercise price of 1.97. Then I'll exercise the call option. And instead of buying from the market at 2.05, I will buy from the option seller at 1.97. So the call option will be exercisable only in the third situation. So in the first situation, how much will a pound cost me? $1.91, but I have already paid a premium of $0.04. So the likelihood of the pounds will cost me 1.95. And this has a probability of cost of 1 pound per dollar and with a probability of 0.25. If I don't exercise the option and the dollar pound is 1.95, then again, together with premium, it will cost me $1.99 per pound, and this has a probability of 0.60. And in the third case, it will cost me 1.97 together with a premium of 0.04, which means 2.01, whereas this has a probability of 0.15. So the expected cost, if I use the call options, is summation XIPI as we use, which is equal to 1.95 multiplied by 0.25 is 0.4875. 1.99 multiplied by 0.6. This is 1.1940, and 2.01 multiplied by 0.15. This has a probability of 0. Expected price 0.3015. So if you will add all the three, you will end up getting the cost of 1 pound in terms of dollars when the call option is exercised or not. So the expected price at call option is 1.983. Okay, so let us now look at the questions when we have done our basic working. First question, what is the expected dollar amount needed if XYZ does not hedge? So if you're not using forward, you're not using money market, you are not using option, then what is the expected dollar amount if we do not hedge? In that case, we have to find out what is the expected price of the currency, looking at all three possible scenarios with the respective probability. So 1.91 multiplied by 0.25 plus 1.95 multiplied by 0.60 plus 2.05 multiplied by 0.15. This is the expected price of 1 pound after 180 days. $0.4775 plus 1.17 plus 2.05 into 0.15, 0.3075. So expected price is, adding all the three, we have 1.983 1.955. So 1 pound is expected to be $1.955, and 300,000 pounds multiplied by $1.955 is 5,86,500. So the correct answer is D. What is the expected dollar amount needed if we do not hedge? $5,86,500. Let us look at the second question. If XYZ Limited chooses the forward contract option, what is the expected dollar amount needed in 180 days? So we have already calculated if forward is used as a hedging technique, the dollar outflow will be 5,88,000 after 180 days. 5,88,000. 300,000 pounds multiplied by 1.96. That's the dollar price, forward price. 1 pound is equal to $1.96. So 5,88,000. The third question is, under the money market hedge, approximately how much will be the XYZ Limited repay after 180 days? This also we have calculated. The money market hedge said it would be somewhere around $6,05,742. $6,05,741. Our next question is, if XYZ Limited chooses the call option contract after 180 days, what is the total cost in dollars for 300,000 pounds, inclusive of interest on premium amount? So far we have calculated that the call option will cost 1.983. So 300,000 multiplied by 1.983, that was 5,94,900. Premium was to be paid upfront, and it was $0.04 per pound, which means 300,000 multiplied by $0.04 comes out to be $12,000. This amount you will borrow, or if you don't even borrow, there is a cost to it, which is at the rate of 5.5%. So if interest is to be levied on the initial investment of 12,000 pounds, $12,000 premium under the option contract, then 5.5% interest on 12,000 for 180 days. The interest amount comes out to be 660. Interest on $12,000 at the rate of 5.5% for 180 days equal to $660. So this will be an additional cost, and we have to calculate what is the total amount of dollar outflow if we use call option and including interest. So 594,900 plus 660. Therefore, the total dollar outflow will be $5,95,560. If we look at the interest, together with interest, we will have 5,95,560 as the dollar out. Now, if you compare, under options, you have 595,560. Under money market hedge, it is crossing 6 lakh, so it's very high. Under forward contract, you have 5,88,000. And if you do not hedge, it is 5,86,500. So the cheapest option is 586. However, if you want to cover the risk, 586 is the cheapest, but there would always be a risk. Therefore, if we want to hedge, forward is the cheapest option. Otherwise, we can go for option and then money market. If you rank, which is the best option? One more question. What is the expected spot rate of the pound after 180 days? So we have already calculated that in the first question itself. It is 1.955. So if you will round off this, it will be $1.96. So this is the correct answer. So this is how you use the options to hedge your foreign exchange exposure. Forward contracts, options, money market hedge. We'll quickly discuss about futures now. So if the same question was on futures, we will first look at what is the asset or a liability. So whether you have receivables or payables. If you have receivables, it is an asset, but if it is payables, it is a liability. So how does futures work? Let's see this. Here, if we look at the previous question, there was a liability of 300,000 pounds. After what time this liability is to be paid? 180 days or 6 months. Which hedging technique are we using? We're using futures. So how will you hedge? Because you have to pay the 300,000 pounds. You are fearing the price may increase of the pounds. So if the price of pounds increase, you will have to end up paying more. So if the price is less today, you end up buying the pounds futures. So what is the hedging technique you use when you have a liability? You buy the foreign currency futures. If the futures are not available on pounds, they are available on dollars, you will sell dollar futures. Now, each currency has a standard size. Pounds have a standard size of 62,500. One contract is of 62,500. So when you will see how many contracts you need to buy to hedge 300,000 pounds. 300,000 pounds divided by 62,500. You need to have 4.8 contracts. When you have 4.8 contracts, you can have exact number of contracts. You cannot have a fractional contract, which means you must round it off to 5 contracts. Okay. And this is the reason in futures, because you have taken 62,500 into 5 pounds. The total number of pounds involved in 5 contracts are 62,500 into 5. So we have 3,12,500 pounds futures which we have bought. Now, when there would be a change in future price at settlement, the gain or loss will not be on 300,000 pounds, but it will be on 312,500 pounds. So if it is a gain, you will end up gaining more than on 300,000 pounds. But if it is a loss, your loss will also be higher. Now let's say that the futures are available for $1.98. These 5 contracts will require you to pay some margin. So let us say $12,000 is the margin per contract. So you end up paying 12,000 into 5. You end up paying $60,000 at present. What is the future price at settlement? Let's say it becomes $1.99. It means what you were fearing is true. Your futures price for the pounds have increased by from 1.98 to 1.99. Now, what will be the gain or loss on future? There would be gain because as you were anticipating, the price has increased. How much is the gain? The gain is of 1.99 minus 1.98. So the gain is of $0.01 per pound. And you had 5 contracts with 62,500. So your future gain would be 0.01 into 3,12,500. You will gain $3,125. Let us say the interest in dollars was 5.5%. So this $60,000 will be costing you at the rate of 5.5%. So there would also be interest cost. If you use your own money, there would be opportunity cost. If you borrow this, there would be interest cost. So $3,300 is the interest cost. $3,300. Now, what will be the total outflow or inflow? Now, you will buy the $300,000 pounds in the spot market. So let's say 300,000 in the spot market, and spot rate does not converge with the future. Let's say spot rate is 1.96. It is always not necessary that it is 1.99. There would be some difference in the futures at settlement and the spot price. So 300,000 into 1.96. The spot price comes out to be 5,88,000. I have taken this 1.96 based on the probabilities of the previous question only. So what is your net inflow or outflow? You have 5,88,000 plus there was this gains on future. So $5,88,000 plus gain on future $3,125 minus the interest cost of $3,300. So your net outflow will be 588 plus 3,125 minus 3,300. $5,87,825. This is how the futures work. So quickly, what will you do when you will have a liability to settle? You will buy the pound future or the foreign currency futures. Futures always have a standard size, so you will have to find out how many contracts you have to take. You will round off the number of contracts. Had this been 4.5, you could have rounded off to 5 contracts, or you could have taken 4 contracts and left some portion uncovered. Then you will look at what the future is available at and what are the future at settlement. So if you have bought it and if the future prices have increased, there would be gain. And if you have sold it and if there is an increase, there would be a loss. So here we had a gain. And your foreign currency, you will buy from the spot market. Let's say spot is 1.96. So you bought the 300,000 pounds from the spot market at 1.96. This is your total dollar outflow, which is the same as had you been unhedged. And this, if you will subtract from this, the foreign currency gain. So, sorry, this is your outflow. This is minus. Then you have minus 3125 from this. So this is your gain and minus interest cost. So your outflow will be 588,000 has gone. From there, 3125 is recovered from the futures gain. So your outflow becomes 584,875, but together with interest, it becomes 588,175. It's an outflow. So what is the net outflow? We will calculate. Dollars will go 5,88,000. Plus you will have a gain on futures 3125 and interest is again a outflow. So total net outflow will be 5,88,175. Okay. The same mechanism will work oppositely if there was an asset. So if there is an asset, let's say you had 300,000 pounds receivables after 180 days, because you have receivables, you are fearing that it might not go down. So you will sell pound futures. Contract size will come out to be again 3 lakh divided by 62,500. You will have the same figure of 4.8, which you will round off to approximately 5 contracts. And futures are available at $1.98. Initial margin was 12,000 per contract, so $60,000. Futures are settling at 1.99. This time you will have loss on future. So something which you have sold for 1.98 is now selling for 1.99. So once again, there is a loss of 0.01 into 5 contracts into 62,500. So your loss will be also same as in the previous question. So into 5 into 62,500. The loss will be of $3125. Total inflow, because you have receivables this time. So total inflow will convert your 300,000 pounds at the spot rate This you will receive so you're going to receive $5,88,000 and interest cost was 3,300. This will be outflow again. So net outflow and inflow here would be you are receiving plus 5,88,000. However, you've lost on futures $3,125 and you've also paid an interest of $3,300. So your net inflow would be 5,81,575. So this is how futures will work. So whatever the foreign currency is, if it is receivable, sell futures of foreign currency. And if price increases, there will be loss. And if the futures price decrease, there will be gain. So your inflow plus gain or minus loss and minus any interest cost on the margins you have paid at the inception of the contract. This would be your total inflow. So this is how the futures work. So these are the 4 hedging techniques which you will use in the foreign exchange. There is one more concept which I would like to discuss. Supposing you are wanting to hedge a forward contract or a future contract or option. Let's say your pound 300,000. They are not to be paid or received in 180 days. Let's say they are to be received after 2 years or after 3 years or 1.5 years. So if they are to be received or paid after a long period of time and you don't have a forward contract expanding up to that many years, how will you manage the exposure? So we are talking about rollover forward contracts. What do we mean here? There is an Indian firm and it has undertaken a contract in US. Whatever the payment is, which is USD 100,000, going to receive after 18 months. So our Indian firm has dollars receivables, but after 18 months. And the forward contract is not available directly for 1.5 years or 18 months. So what will you do? You will look at how much period the forward contracts are available. It's 6 months. So you will keep on entering a 6 months forward contract till 1 year. So for this is the entire period, breaking down into 6 months, 12 months, and finally 18. Okay. Now what will you do? At this period, you will enter a forward contract. As you have receivables, you will sell the dollars at this price, the forward contract which is available. After 6 months, you will again enter into a 6 months forward contract to sell dollars. And after 12 months, you will again enter into a 6 months forward contract to sell dollars. But that doesn't mean you enter into 3 contracts to sell the dollars which you will receive. This contract has to be cancelled. Okay. So how will you cancel it? Buy dollars in the spot. Buy dollars. And how will you cancel this? This gets cancelled. How will you cancel this? This also gets cancelled when you buy the dollars in the spot. For this contract, which you have taken at the end of 12 months, this will be honored because after 6 months, like 18 months, you are going to actually receive the $100,000. So this mechanism will help you to hedge your dollars, which are receivable after 18 months. So let us look at what are the price of dollar today. Spot price is 92 and 92.10. So you have the bid and the ask. After 6 months, forward is available for 91.90 and 92. So today what you're going to do is enter into a forward contract to sell your dollars. So will the bid be applicable or ask? You will enter into a forward contract to sell your dollars at 91.90. Okay. So you have entered first step. Zero position, or we can call it today. What you do? Enter into a 6 months forward contract to sell dollars, $100,000. The rate applicable will be $1 is equal to 91.90. This is the forward rate, and we will use bid. That's what we are going to do in position 0. After 6 months, now you have to sell dollars at 91.90 as per the forward contract. But you will not have the dollars at this time. Why? Because the dollars are receivable after 180 days, after 18 months. So buy dollar 100,000 in the spot market. So when you will buy the dollars in the spot market, ask would be applicable. So after 6 months, what is the spot market? USD to INR is 91.70 and 91.8. And you're going to buy from the spot. So $1 is going to cost you 91.80 rupees. Still, there is a gain. It was sold for 91.90, but you are buying it at rupee 91.80. So there is a gain of 0.10 rupee per dollar multiplied by $100,000. So there is a gain of 10,000 rupees here. So after 6 months, first you cancel out your forward position, which you have sold for 91.90. You buy from the market and sell it at 91.90. The ask rate after 6 months in the spot market is 91.80. So you're buying at 91.8, selling at 91.9. There is a gain of 10 paisa on per dollar. So on $100,000, your total gain will be 10,000. Now you have 1 year after which you will receive your $100,000. So you enter into another contract to hedge yourself for $100,000 receivable now after 1 year. But the contract is again available for 6 months. So you enter into a 6 month forward contract, which will expire 1 year from the start date. And again, you sell your dollars. Now, after 6 months, the 6 months forward is 91.60. I'll use a different thing. So what is happening after 6 months? You are squaring off this position by buying dollars in the spot and selling the forward. And you enter into another 6 months forward contract to hedge your $100,000, which you will receive after 1 year. But you don't have a contract for 1 year, forward contract for 1 year. So you enter into another 6 months forward contract and you want to sell your dollars. So it is available at 91.60. So now you have entered into another contract for 91.60 forward contract. And there is a gain of 10,000 in squaring of the previous forward position. Okay. So let's move after 1 year of the contract. Square of your position of the forward contract by buying from the spot market. Okay. So you will buy in the spot market to be able to sell the forward contract which you have entered. After 12 months, what is the scene? Spot market says 91.40 and 91.50. So to square off the position, you will buy at 91.50 and execute this forward contract, square off this at 91.60. Buy at 91.50 and forward contract to be squared off was for 91.60. So buy at this and sell as per the forward contract at 91.60. So again, there is a gain of rupees 0.10 and multiplied by 100,000. Your total gain is 10,000 rupees. So your forward contract has been squared off, but you want to hedge again for the dollars which will be received after 6 months now. We are already 1 year after the contract. So now dollars are another 6 months away from being received. So you will enter into another contract to sell your dollars at 91. So after 12 months or 1 year, hedged dollar received after 6 months at the rate of 91. So you have in the process gained 10,000 after 6 months, 10,000 after 12 months, and finally you have a forward contract to sell your dollars at 91. So after 18 months, you receive dollars 100,000 and honor the forward contract at 91. So you sell at 91, you end up getting 91 lakhs. So so the price has definitely decreased. Your fear was true. You needed to hedge because dollar, which is trading at 92, is now available at only 91. So the dollar is depreciating continuously. But you have taken a rollover forward, and in that process, despite a decrease or depreciating dollar, you gained 10,000 after 6 months, another 10,000 after 12 months or 1 year, and finally you could sell your dollar at 95, 91, the 6 months forward price at which you had already undertaken. So after 18 months, you will sell your $100,000 at 91, not at 90.80. And you will gain 10,000 and 10,000 after 6 months and 12 months. So to some extent, you were able to cover up your loss. So find out what you will receive under the rollover forward contract. So the answer is under the rollover forward contract, we're going to receive 10,000 after 6 months, 10,000 after 12 months, and 91 lakh after 1.5 years. The period 18 months from now when you actually received your dollars. We also have to calculate the present value of the total receipts. So in today's scenario or at zero position, what is the receipt? Had we received our dollars 100,000 today, we would have got 92 lakhs. But now, because dollar depreciated, we got something less. Let's compare with today's position, how much we got using the discount rate at 8%. So then it becomes simple. 10,000 after 6 months, the present value of 10,000 after 6 months adds 8% per annum rate of interest would be this. Another 10,000 after 1 year, you can take it at 0.8 or you may take it at 0.4 square. And another 91 lakhs after 18 months. So if interest is taken semi-annually, 91 lakh after 18 months is 1.04 cube. So 8% per annum is equivalent to 4% for every 6 months. So 10,000 is received after 6 months, another 10,000 is received after 12 months, and 91 lakh is received after 18 months. the third 6-month period. So 10,000 divided by 1.04, it's 9615 plus 10,000 divided by 1.04 square. I'm rounding off in multiples of 1 rupee. 9246 and 91 lakh divided by 1.04 cube comes out to be 80 lakhs 89,867. Just check this figure. So the total inflow is $100,000 becomes 81 lakh 8,728. So the present value of 92 lakh, which was to be received, or 100,000, which is to be received after 18 months, is 80 lakh, 81 lakh, 8,000. Had we received just today, we could have got 92. Or if the price had remained constant at 92, we would have got the present value of 92 lakh. And if you compare 92 lakhs, then the present value of 92 lakhs would be 81 lakh. Had the price did not fluctuate, then we would have received 92 lakh without hedging, right? That would have been equivalent to 81 lakh 78,000. So obviously there is a loss because of depreciating dollars, but still we could cover it under the forward contract. And because we had a rollover forward contract, we still managed to get 81 lakh 8,000, if not 81,78. So this is how you will hedge if the amount receivable or payable is not immediate. It's a long duration when we will be receiving or paying, and the forward contracts or the hedging mechanism is not available for as long duration. So you will use the rollover forward. One next question that we have is early delivery. So this is your topic on early delivery. What happens when you enter into a forward contract, but you are not able to honor that contract on that date? If you have receivable, your importer says in the foreign country that he wants to pay early, or if you have payables and you get funds from somewhere, and that person says that, okay, if you want to make the payment early. So that's the concept of early delivery. So on 1st October 2024, Mr. G is an exporter. He enters into a forward contract with bank to sell $100,000. So Mr. G is an exporter. Obviously, an exporter in India will be having receivables. And he enters into a contract with bank to sell USD. So that means he has exported to US. So he has USD receivables. So what he will do to the USD receivables, he will sell it to the bank in India. So the Mr. G exporter enters into a forward contract with the bank to sell the US dollars 100,000 on 31st December 2024. At what price? 85.40. So on 31st December, G was supposed to receive 85 lakh 40,000, right? However, at the request of the import, Mr. G received the amount on 30th November. So that's exactly 1 month before the time came for receiving the payment. Now, what will Mr. G do? He will request the bank to take the delivery early. He will ask the bank to make the remittance on 30th November 2024 before the due date. So bank will remit this amount, but this can cause some inconvenience to the bank. For that, the bank may charge interest. The bank may also charge the loss it may face because of this, which is also called the swap difference. So the interbank rate on 30th November is spot and 1 month premium is 10 and 15. So your question is, if the bank agrees to take early delivery, what will be the net inflow of Mr. G? So first we'll have to calculate the swap difference. Bank will receive $100,000 on 30th November. This bank will have to sell in the spot market, and the interbank rate on 30th November 2024 is USD 85.22 oblique 85.27. So as the bank will have to sell, bid rate would be applicable. So the bank sells $100,000 at 85.22. But the bank would have already covered itself that whatever the dollars Mr. G will give, he will sell in the market. So bank would have already covered itself on for 31st December. But now on 31st December, the bank will not receive 100,000 from Mr. G. So bank will have to buy 100,000 for 31st December on 30th November. So bank will enter into a forward contract on 30th November to buy $100,000. On 30th November, the rate would be for 1 month forward. Looking at the premium, these are swap points. Premium is increasing from left to right. That means the price have increased by 10 and 15. So the forward rates would be 85.32 oblique 85.42. So bank will enter into a forward contract to hedge itself for the position it must have taken on the basis of G's contract. And now it will have to buy at 85.4. Forward contract at 85.4. So the swap difference is, so bank is selling at 85.22, buying at 85.42. There is a loss of 0.20 to the bank multiplied by 100,000. The total loss to the bank would be rupees 20,000. So the loss is 20,000. Swap difference is 20,000. Then there is also going to be an interest cost. So what will be the interest cost to Mr. G if he takes early delivery? what would be the bank outflow to Mr. G? As on 30th November itself, the transaction has happened. So the amount which was supposed to be an outflow of 85,40,000 on 30th November, 31st December has become on 30th November. So bank's outflow will be 85,40,000. 1 lakh dollars at 85.40, the price of the forward contract which Mr. G has entered to sell the dollars. This bank will be able to sell in the market at 85.22. And bank's inflow will be 85,20,000. As bank sells at 85.22. Net outflow to the bank, $18,000 extra or outflow, which has gone 1 month earlier. So bank will charge interest on 18,000 for 31 days. The payment which was supposed to go out on 31st December is going on 30th November. Said assume 365 days in a year and assume the prevailing prime rate is 18%. So if the prime rate is 18% and deposit rate is 12%, all calculations to be rounded off up to 2 decimal points. So, all right, we have understood that Mr. G was supposed to sell the US dollars to bank on 31st December at 85.40, but he approached the bank on 30th November to take early delivery. So on 30th November, bank did pay him 85,40,000, but bank had to sell those dollars in the open market in the spot on 30th November at 85.22 in the interbank rate. So the outflow to the bank for these funds was 18,000 and lending rate is 18%. So we will calculate the interest on 18,000, taking 365 days in a year at the rate of 18%. 18,000 into 18% for 331 days. Calculations to be rounded off to 2 decimals. So the interest is 275.1. So interest cost to Mr. G if he takes early delivery is 275.18 rupees. Right? 85,40,000 is rupees, 85,22,000 rupees inflow to the bank. Net outflow to the bank is rupees 18,000 and interest on rupees 18,000 for 31 days at 18%, taking 365 days in a year is rupees 275.18. Now, let us now answer the first part. What will be the net inflow to Mr. G? $85,40,000 is what he should have got, but there was a swap loss of 20,000 to the bank and there is interest cost which is charged to the customer or Mr. G, 275.18. So net inflow to Mr. G would be 85 lakh 40,000 minus 20,000 to 75.18. 85 lakh 19,724.82. We can call it 25 here, but because the question is specifically asking to round off calculations up to 2 decimal points, we'll keep it that. Our next question is, if Mr. G could have deployed these funds in USD and earn a rate of 3% per annum, then advise which option will be better, to take the delivery to the bank or invest in USD only. So what is the alternative? Alternative is that Mr. G could not have bought the funds in India on 30th November and would have invested it in US at 3%. So in that case, what would have happened? 100,000 would have got him an interest of 3% for 31 days. 100,000 into 3% divide by 365 per day interest and into 31 days interest. So he would have got an interest of 254.79 US dollars. On 30th November, invested at the rate of 3%, total dollar inflow on 31st December, 100,000 plus 254.79. He would have received the 100,000 by honoring the forward contract at 85.40. So he would have received 85 lakh 40,000 from that. And the interest amount of dollars, $254.79 would have been sold in the open market, would have been sold at spot rate. So the spot rate is expected to be 85.32. If the spot rates are given, interbank rate on 30th November, spot INR USD this and 1 month premium this. So he would have sold at 85.32. $254.79 multiplied by 85.32. Another 21,738.68, or I'll keep it 39. So 85 lakh 40,000 plus 21,739. So his inflow would have been 85 lakh 61,739 or 38.68, as the question is specifically asking to keep the answers in 2 decimals. $85,61,738.68. Okay. So what has he done? He has received the dollars in US on 30th November and invested them there at 3%. So 254.79 was his interest, and his total inflow on 31st December would have been 100,000 or 1,254.79 dollars. For $100,000, he already has a forward contract at 85.40. But for the remaining interest portion, this he will sell in the spot at 85.32. So he will get 85 lakh 61,738. Or he could have entered into a forward contract on 30th November itself, where it was for 10 and 15 premium, which would have locked his price at 85.32. Here I am assuming that the forwards were available at this price, or you may assume that the spot was this. Another thing is advise him which option would be better. Would take delivery or invest in USD. Now, when you are going to compare this, if he invested in USD, this is the amount he is going to receive on 31st December. Whereas if he bought it to India, he would have received 85 lakh 19,724.82. But we can't compare the receipt on 30th November with the receipt on 31st December. So we must take the interest element, or we must assume that he has deposited whatever 30th November he received in India. And for that, the deposit rate is 12% per annum. So when we will compare, we will not compare 85 lakh 19,000 with 85 lakh 61,000, because this figure is as on 31st December. Whereas 85 lakh 19,000 724.82. This figure is on 30th November. So this must be invested at the rate of 12% for 31 days. And we would have got the figure on 31st December. So when 85 lakh 19,724.82 is invested in India at 12%, it will gain an interest of 86,831.17. So when you add 85 lakh 19,724.82 with 86,000 interest, which is earned on this, the total inflow becomes 8 lakh 60,000 or 86 lakh 6,555.99 or 556. So if you had invested in US, you would have got 85 lakh 61,000. But if you had invested in India, you would have got 86 lakh 6,556. So therefore, investment in India is better. So what is the inflow to Mr. G if he takes early delivery and invest for 1 month? 85 lakh 19,724. Plus interest at the rate of 12% for 31 days. which comes out to be 86,831.17, and your inflow is 8 lakh 60,000, 86 lakh 6,555.99. So what will be the net inflow to Mr. G if he takes early delivery and invest for 1 month in India only? Then it would be A. Now 86 lakh 6,000 is more than 85 lakh 61,000. Therefore, what advice do we give? We advise him to bring the money on 30th November in India, take early delivery from the bank, and invest in India at 12%. So that would be more beneficial to him. Okay. Then we can take a 5 to 10 minutes pause, and then we start with the international financial market. Okay. A short break of 10 minutes, and then we'll start with the international financial management. Life of the project is 2 years. The unlevered cost of capital is 12%. The spot rate at present is €1 is rupee 90. Corporate tax rates in India is 30%. And whatever the amount, 50% of the money will come through debt. So 50% debt would be required. There is an Indian company. Total investment is going to be 40 lakhs euros, out of which 50% will come through debt and 25 lakh would be the inflow in next 2 years each year. Cost of capital is 12%. Spot rate is 90 and tax rate in India is 30%, 50% debt. Now, the financing option of 50% borrowing, it can come either from India, option A, which will be at 9% rate per annum. It could come from Europe, which is 5%, or it could come from US at 3%. So if you look at the rate of interest, the rate of interest is lowest in the US. However, it is assumed that the interest rate parity will hold true, but there's no transaction cost. So we have to identify which option is the cheapest and why. Particulars further given is that the spot USD to INR, $1 is 75, €1 against USD is 1.20. Interest rate in the USA is 3% and Europe is 5%, which is already mentioned here also. So same information. So we have to identify which option is the cheapest and why. So let's try borrowing in India, Indian currency, in European currency, or in US currency. Let's see how it will impact. But first, let's also calculate the forward rates which will be applicable after 1 year and after 2 years. And present value factors are given at 12% and 5%. So first, let's find out the forward rates. We have three exchange rates to deal with. One is directly the spot rate. Basis that we will calculate the 1 year forward rate. And 2 years forward rate. The spot rate for Euro to INR is given as 90. The spot rate for USD INR is given as 75. And therefore, Euro to USD, you can calculate the cross rates also, or that was given as 1.20. Let us now look at the forward rates. In Europe, the rate of interest is 5%. In India, it is 9%. And in US, it is 3%. Okay. So 1 year forward rate would be 90 into 1.09 divided by 1.05. 93.428, or I'll take till 3 decibels, 429. And 93.429 multiplied by, once again, 1.09 and divide by 1.05, it's 96.9899. I can take 988. Here you have 75 multiplied by 1.09 divide by 1.03. This comes out to be 79.369, and 79.369 again multiplied by 1.09 and divide by 1.03. It's 83.992. Now calculating the euro by USD, 93.429 divided by 79.369. 1.177 and 1.1547. So first, let us look if we borrow in India. We need 40 lakh euros, and out of this, debt would be, so borrowing in India, total borrowing would be 40 lakhs into euro is at present for 90, right? $360 lakh. That is 600 lakhs, sorry. 3,600 lakhs. That would be 1,800 lakhs. And interest would be 9% for the first year. So 162 lakhs would be the interest for the first year, and interest for the second year again at 9%. So if you look at total repayment of the loan borrowing option, you will repay after loan after 2 years, 1,800 lakhs plus 162 and 162. So you end up paying 2,124 lakhs. This will be the outflow for the loan after 2 years. Okay. Your rate, you may get some different answers if you use directly here 1.20 into the rates in Europe and USD. Or if you first take USD by INR, then Euro by USD, and then calculate Euro by USD, so on. So you might get some small differences because of the decimals. That is okay. Now let us say what happens when you do the borrowings in Euro. So when you will borrow in Euro, your total requirement is 40 lakh euros. You will borrow half of it, 20 lakh euros. After 1 year, you pay an interest of 5% on 20 lakhs. Euros. Okay. It is 1 lakh euros. And after another 1 year, you will pay interest again at 5%, 1 lakh euros. Then you will repay 20 lakh euros. So here, if we convert it into Indian rupee, the interest you pay after 1 year. So 1 euro is equivalent to 93.429 euros. And this 1 lakh which you pay after another 1 year, 96.988. And the 20 lakhs also you will pay at the end of 2 years, 96.988. So the total outflow in rupee will be 93 lakh 42,900, 96 lakhs 98,800, and 20 into 96.988, 1939.76 thousand. So total outflow will be 93,000, 42,900. Your total outflow would be 2130 lakhs, 2130 lakhs, 17,700. What was the outflow in terms of Indian rupees? 21 lakh, 2124 lakh. And here you have 2130 lakh, 17,700. Third option is you can borrow in US dollars. So once again, the amount you need will be euro 40 lakhs. So what you need to borrow is 20 lakhs or 2 million euros. The current rate of euro is, in terms of USD, is 1.20. Therefore, in terms of USD, you will be borrowing 24 lakh dollars. One-year interest at the rate of 3% per annum. 0.72 lakhs USD. After second year interest, again at 3% per annum, 0.72 lakhs USD. Convert it into INR. 75, 79.369, and 83.992. 79.369. 79.369 and 83.99. And you will repay the 24 lakhs here at 83.992. So total outflow because of the borrowings will be 0.72 lakhs multiplied by 57 lakh 14,568 and 83.992 multiplied by 0.72 lakhs. This is 60 lakhs 47,424 plus 24 lakhs into 83.992, 2,015 lakhs 80,800, or 20 crores 15 lakhs. So this is 2133.42792 lakhs. So if you compare it, you find that it is best to borrow in India only. That will be cheapest option. There is an alternative situation to this. An alternative solution can be if you simply compare the interest rates. So if we simply compare the interest rates, in India, the interest rate is 9%. And if you consider after tax cost, the tax rate is 30%. So the after tax cost would be 9 into 1.1 minus 0.3, or 9 multiplied by 0.7, So it will cost you 6.3%. In Europe, the rate of interest is 5%. So after tax, it will cost you 5 into 1 minus 0.3%, 30%, which is 5 into 0.7, which is 3.5%. But if in US you agree, it is 3%. However, if interest rate parity holds good, it will ultimately be 3% into 1.05, the rate of interest in Europe, divided by rate of interest in US. So it will end up, it will cost you 5% only, and then 5% after tax is once again the same. So because of the interest rate parity holding good, the lower rate of US interest will not be able to take any benefit of it. This will get neutralized because of the currency, European currency, which will which will depreciate against US currency. So whatever the benefit you had against borrowing in US at 3%, that benefit will be lost because the euro will depreciate against dollars. Therefore, no matter whether you take loan in Europe or you take loan in US, because of the interest rate parity, they both will hold good. So if you compare the interest rates, the borrowing in Europe and US is exactly same and better than borrowing in India. But if you look at this solution, we find here that it is the borrowing in India will be costing us lowest. The repayment or the outflow after 2 years will be minimum if you borrow in Indian rupee. So this was the question which was there in the last exam, and you have to compare. Which option is cheapest to borrow, whether you borrow from India or Euro or US? Okay. So we have taken the interest rate calculation on that basis. As per the interest rate parity, we found out that it is better to borrow in Europe or US. It would be cheaper. But if we compare overall by converting all the currencies into Indian currency, we find that borrowing in India will be the least costly thing. All right. Another question on international financial management. The treasury desk of a global bank incorporated in UK. So it's a treasury desk, global bank, but it is incorporated in UK, and therefore it wants to invest the Great British Pound 200 million on 1st January 2019. So you have got 200 million pounds to invest on 1st January 2019 for 6 months. The first option is that the equity trading desk in Japan wants to invest the entire amount of 200 million pounds in high dividend yielding Japanese securities, which would earn a dividend income of Japanese yen 1182 million. So you can invest 200 million in Japan, you will get 1182 million Japanese yen as dividend. The dividends are paid on 29th of June. So exactly after 6 months, there is no need to bring it to the present value. Post-dividend, the securities are expected to quote at 2% discount. So the price at which you bought the securities, the price of that security will fall by 2%. So there would be a capital gain loss by 2%. The desk also plans to earn Japanese yen 10 million on a stock borrow lending activity because of this investment. So another inflow, 1182 is dividends, 10 million is through stock lending activity. These will be sold on 29th June with a T+1 settlement. So you get the money exactly on 30th of June. And the amount remitted back to the Treasury in London. The fixed deposit, the second option is fixed income desks of US, which proposes to invest the amount in 6 months G-SECs, that's government securities, which provides a return of 5% per annum. 5% per annum. So in this 6 months, you're going to earn 2.5%. The currency conversion rate or exchange rates are as follows. The Japanese yen against pound is 148 on the spot, 148.0002, and on 30th June it will be 150. Whereas the pound and USD are trading at 1.28000, and in the forward it is trading at 1.30331. As a treasurer, you have to advise the bank on the best investment option. What would be your decision from the risk perspective? You can ignore taxation and calculate all figures in millions and round them up to 4 decimal points. So if we have any intermittent figures also, that also will round off until 4 decimals. So to begin with, number one, we invest in Japan looking at option 1. So convert the 200 million pounds equal to 200 multiplied by 148.0002. So we had 200 million and 148 into 0.0002. So this is going to be your investment in Japanese yen. 200 multiplied by 148.0002. That is 29,600.40 Japanese yen. This is on 1st January. On 30th June, when you sell these investment on 29th and receive the proceeds after 1 day, T+1, transaction date plus 1 day for settlement. So your securities will sell at 98%. So they will fetch you 29,008.392. You also had received dividends in between and stock lending activity. Dividends are received once again on 29th June. So we will take once again. Okay, not on 20, paid and declared and paid on 29 June, 1182 plus 10 million. So your total amount is 30,200.392 million. We will convert it back 2 pound at the rate of 150. So this figure, when divided by 150, it gives you after 6 months 201.3359 pounds. So your net gain is this minus 200, 1.3359 pounds. Let us now invest in US. 200 pounds is equivalent to 200 into $1.28. So you get 256 USD. Interest on this at the rate of 2.5% is 6.4 million USD. Total amount becomes 262.4 million USD. Converted back, 262.4 divided by using the forward rates 1.30331. And you end up getting 201.3335. So if you compare it till the last four decimals, here the gain is 1.335 million pounds, whereas the gain is 1.3359 million pounds. So you cannot ignore the 59 compared to 35. 59 is more than 35 when you're taking till four decimals, specifically when your figures are in millions. So it will cause around a difference, and investment in Japan is definitely more lucrative as compared to the investment in US. But that is when you are ignoring the perspective of risk. So as a treasurer, advise your bank on the best investment option. If we take the risk perspective, which we must take considering the best investment, Japanese investments are in equity. Equity is a risky investment as compared to the government securities in US. So if we assume the risk in government securities to be zero, default risk would be zero, it is better to make the investment in US G-Secs rather than to invest in Japanese yen. So if we take the four decimals, here you are getting 13,33,527, and here you are getting 13,33,590. So a very negligible difference in euros. Okay, it is 35,300 3,527 and it is 5,900. So just 2,000 difference, but the risk is enormous. Therefore, if we consider the best investment, it is suitable or better to invest in the US securities. So considering the risk involved in Japanese equity investment, which is giving a slightly higher return. You can exactly calculate and put the amount in euros. How much it is? 1.3359 after rounding off till four decimals minus 1.3335. So it's 2,400 euros, pounds. So 200 million is invested. On that investment, if you're getting just 2,400 pounds extra, considering the risk involved in Japanese equity investment, which is giving a slightly higher return of 2,400 pounds, it is worth investing in US government securities only. So investment in US government securities would be a better investment as compared to the Japanese yen. Equities are always a little more expensive as compared to the government securities. They will always be. So the reward we are getting with taking the enormous risk is not justified. Let us look at another type of question that you get in international financial management. Here, Messrs. Raghu Limited is interested in expanding its operations and planning to install manufacturing plant at US. It requires 8.82 million USD net of issue expenses or flotation cost. To fund the proposed project's GDRs are proposed to be issued to finance this project. So we need 8.82 million net of issue expenses, and we are trying to finance this using GDRs, Global Depository Reserves. The estimated flotation cost is GDR 2%. There is additional information. The market price of the share at the time of issue of GDR is rupee 360. So Indian rupee will be kept with the depository bank in US, where it would be converted into a GDR. And each GDR will represent two underlying shares. So the investors in US will be able to get depository receipts. Issue is also to be priced at 10% discount to the market price. And the current exchange rate is 1 USD is 72 rupees. First, we'll ignore the dividend part. We'll come to it later because that will be relevant to calculate the cost of issuing GDRs. But let's first find out how many GDRs, what we will get, and what is how you will manage that. So you, as a financial consultant, are required to compute the number of GDRs to be issued and the cost of GDR. So I'll take the first part only of this part one. How many GDRs? Amount to be raised? USD 8.82 million. Right. 8.82 million. Flotation is 2%. Therefore, gross amount to be raised 8.82 divided by 1 minus 0.02 flotation. So that is 8.82 million USD divided by 0.98. So you need to raise exactly 9 million USD. Price of one share, rupees 360. Price of two shares comprising of GDR. Two shares will underline the GDR. Therefore, rupees 360 into 2, that is 720 rupees, issued at a discount of 10%. So the price of one GDR would be 720 minus 10%, which is equal to 720 minus 72, which is equivalent to 648 rupees. Right? So one GDR would be for 648 rupees. We need to raise $9 million and the exchange rate is 72. So one GDR in US currency would be 648 divided by 72, which is exactly one GDR in USD. 648 divided by 72 exchange rate is equal to 9 USD. So number of GDRs will be 9 million to be raised, and the price of one GDR is 9 USD. So we will raise 1 million USD. 1 million GDRs have to be raised. First part clear? First find out how many GDRs, how much do you require, net of flotation costs. So the gross amount you will raise is 9 million. One GDR comprises of two shares, which is priced at 720 or 316 to 2, but will be issued at 10% discount. Therefore, the price of one GDR is 648. The exchange rate prevalent is 72. 1 USD is equal to 72 rupees. So 648 divided by 72, one GDR would be for 9 USD. 9 million to be raised. Price of one GDR 9 USD. Therefore, we will raise 1 million GDRs. Second part, what is the cost of the GDR? So if you look at the dividend expected to be paid at the rate of 20% with growth rate of 12%. So firstly, it is the expected dividend. And if we use the dividend price model, cost of equity is given by dividend upon price or net proceeds plus growth. So the dividend is 20%. 20% will be applied on face value of 100. So dividend per share would be 20, but as there are two shares underlying the GDR, the dividend will become 40. E1 is equal to 40. Growth is equivalent to 0.12, and the price of the share was 720 minus 10%, 72, but there would also be flotation cost. So it's 1 minus 0.202. So your net proceeds would become 720 minus 72, 648 into 0.98. The proceeds you will get from one GDR is 635.04 in terms of Indian rupee. So the cost becomes 40 divided by 635.4 plus 0.12. 40 divided by 635.04 makes it 0.0629. I'll round it off to 63 plus 0.12. Therefore, it becomes 0.183, or the cost becomes 18.30%. Next is it clear? So how many GDRs we will issue? Number is 1 million. And what is the cost? 18.3%, 30%. What is your suggestion if the company receives an offer from a US bank which is willing to provide equivalent loan with an interest rate of 12%? So obviously, 12% will be less than 18.3%. You would avail the offer because cost of raising GDR is higher as compared to the loan per cost. So how much will you save? The amount that would be saved is 8.82 million into 12%. Here it will cost you 1.0584 million. Otherwise, it was costing us 8.82 into 0.1830. So 1.61 million USD, or 8.82 into 0.063 multiplied by. So you will save 5.556 million. So there would be saving. How much company can save? 5.556 million. Okay. So you will compare 18.30 with 12%. Bank is not saying that it will have any flotation cost. If you take that, you can increase the cost. Otherwise, you simply compare 18.30 with 12%. So you'll be saving 6.3% on 8.82 million. Our next and last question, most probably on international financial management, that is talking about calculating the present value or NPV of a project, which can also be done in the home currency or which can be done in the foreign currency. So let's look at ABC Limited, which is considering a project in US with an initial investment of 11 million or 1 crore 10 lakhs. US dollar 11 millions. Life of the project is 5 years. The current spot exchange rate is $48 as per 1 USD. The risk-free rate in US is 8%, whereas the same is 12% in India. Cash flow from the project is US dollar, 20 lakhs, 25 lakhs, 30 lakhs, 40 lakhs, and 50 lakhs. You have to calculate the NPV of the project using foreign currency approach, where the required rate of return on this project is 14%. So ABC Limited is an Indian company which requires a return of 14%. However, the risk-free rate is given as 8% and 12%, but the NPV is to be calculated in foreign currency. So our first concern is, basis this, what should be the required return? So it's an easy question. What's the initial outflow? It's 11 million. And what are the inflows? 2 million, 2.5 million, 3 million, 4 million, and 5 million. And required rate, you will simply discount it. But the whole problem is it has to be done with a foreign currency approach. And we don't know what rate to expect or to discount at in the US market. So what should be the discount rate in USD? So for this, we follow a simple approach. What is the required return in India? It is 14%. Whereas the risk-free rate of interest in India was 12%. So why are we wanting 2% extra? Because we are not investing in some risk-free project. We are investing in a project which has certain risk. So we are charging this 2% extra for the risk premium maybe. But to reach out to 14% using 14 minus 12 or 2%, adding 2% risk premium to the risk-free rate, it's a naive approach. How we approach this is, how do we reach 1.14, the discount rate? So it's a combination of 1 plus risk-free rate, which is multiplied by the premium percentage, risk premium. RF stands for risk-free rate, RP stands for risk premium. We know the risk-free rate in India is 1.12, but we don't know what the premium rate is, risk premium. So when you will solve this, you will end up getting risk premium as 1.14 divided by 1.12, which is 1.017857. So 2% was a simple additive approach or a naive approach, but we will follow proper method to calculate the risk premium. Therefore, risk premium becomes 0.101785, and in percentage terms it becomes, or if you add 1 to it, it is 1%, it is 1.785%, not 2% as we calculated by simply subtraction. Now when this risk premium, now the project is same, so the risk premium is same, but risk-free rate was different. So to calculate the required return in USD, we will have 1 plus risk-free rate in US and multiplied by 1 plus risk premium. So this becomes 1.08 multiplied by 1.01785. Which is 1.09928. So I can take 9.9% as the discount rate, and we'll calculate whether the project has a positive NPV or not. So initial outflow is 11 million. Then you're getting 2 million, 2.5 million positive, 3 million, 4 million, and 5 million. How convenient. In the third, fourth, fifth year, 3 million, 4 million, and 5 million. In USD, million. Present value factors at 9.9%. I'll round them to three decimals only. 0.909. Let's take 4 decimals. Multiplied by 11, sorry. 0.9099. The present value factor year 0 will be 1. So 0.9099 into 2. This is 1.8198. Zero point 8279 into 2.5. 2.06975. 698 I'll take. And 0.8279 divide by 1.099. It's 0.7533. 0.7533 multiplied by 3 million. 2.2599. 0.7533. The factors would be given to you, so you don't have to generally calculate. The reason being, we cannot afford to have different answers for different decimals or rounding off. Therefore, it's preferred to have the decimal given in the question so that we get exactly same answers. So if it is given till 3 decimals, you will use that. If it's given 4 decimals, you will use that. There is no terminal inflow. You check out that. No terminal inflow, no working capital, which will come back. You have to remember, otherwise, in the 5th year, you will have inflows from operations as well as some terminal inflow. So when you add up all this, you find that the NPV is 12.009 minus 11. So NPV is positive plus 1.009. Therefore, the project must be accepted as per the NPV criteria. Okay. So this is nothing but a question being solved using a foreign currency approach and using a home currency approach. So had it been home currency, we would have to convert all the cash inflows of the next 5 years into the Indian rupee first using the forward rates and then applying the 14% discount rate or rate of return to calculate the net present value. Okay. We have further time. We'll take up one more question. We have DK Limited. It's considering an investment proposal in Sri Lanka, which involves an initial investment of Lankan rupee 25 billion. The current spot exchange rate is INR upon Lankan rupee is 0.37. So rupee upon Lankan currency, Sri Lankan currency is 0.37. That means one Lankan currency you end up getting only 0.37 rupee. That means Indian currency is at premium. The risk-free rate or Indian currency is more expensive. The risk-free rate, India is 6% and in Sri Lanka it is 5.20. So we have the risk-free rate. 6% and 5.20%. The project will generate 5 billion in the first year and the cash flow will increase by Sri Lankan rupee 1 billion each year for the next 4 years. So it's 5, 6, 7, 8, 9. The project will wind up on completion of fifth year with no salvage value. So at the end of 5 years, the project will be complete. Terminally, you won't get anything. The required rate of return for the project is 8%. So DK Limited is an Indian company which is considering investment in Sri Lanka. So the required rate of return is mentioned as per the Indian company. Therefore, we'll apply the same rule and calculate the risk premium. So 1.06 multiplied by 1 plus risk premium in India gives us 1.08. So therefore, 1 plus risk premium, which is same in India and Sri Lanka, 1.08 divided by 1.06 is equal to 1.0188 6 or 7. When I apply this 1.887 here, I am able to find this as 1.0520 multiplied by 1.01887. So the required rate is 1.07185. I'll round it off till instead of 718, I'll call it 7.72. So the required rate of return is 7.2%. Or we can use 7.185% also. It will cause a little difficulty in calculating the present value, a little cumbersome. Otherwise, 7.185 would be more appropriate. Otherwise, it appears directly from here 2%. 8 minus 6 is 2. So therefore, add 2 to 5.20, you'll get 7.20. But to be able to specifically exhibit that you have calculated using proper formula, let's take the rate of interest, required rate of interest in Sri Lanka as 7.185. So okay, they are given the PVIF at 7%. So it is kind of assumed that you will restrict it to 7%. Ignore 0.185. The PVIF factors are given. Now the calculations are easy so far. So particularly in Sri Lankan currency, 0 year, 1 year, 2 year, 3 year, 4 year, and 5 years, 25 billion is the outflow. Inflows are 5 billion, 6 billion, 7 billion, 8 billion, and 9 billion. So PVIF factors are given at 7%. Use them. This is 1, this is 0.9, this is 0.9, 3, 4, 5, 7. Zero point 0.8, 7344, 81630, 76290, and 0.7129. So simply multiply 25 billion gone and 5 into 0.93457 is plus 4.67285. 6 into 0.87344 is 5.24064. 7 into 0.81630, 5.7141. 8 into 0.76290, it's 6.1032, and 9 into 0.71299, 6.41691. When you will add all this and subtract 25 billion, you will get the present value in Sri Lankan currency. So the present value is 3.1477 billion. Convert it into rupees. In the spot market, what is the exchange rate? 0.37. The NPV comes out to be rupee 1.164649 billion. Now you can do the same calculation when you are doing it in foreign currency. You can do it in Indian currency or the home currency. But to be able to do it in home currency, you need one thing. You need the forward rates. Risk-free rate in India, 6%. Risk-free rate in Sri Lanka, 5.2%. So 1 year forward rate, 0.37 multiplied by 1.06 divided by 1.052. 2 years, 0.37, 1.06, 1.052 square. or you can use the previous forward rate and calculate for the next period. So whatever the forward rate comes here, in the fourth year, we will use that. So first year is 0.37 multiplied by 1.06 divided by 1.052. We can see that the rupee is depreciating a bit, 0.3728. Then again multiplied by 1.06 and divide by 1.052. 0.3756. I am taking till 4 decimals only. Though for the calculation of the next period, I am simply taking whatever the figures are there in the calculator and dividing it by 1.052 and multiplying by 1.06. So in calculators, I'm taking till last decimals. So maybe you will get some difference. Then if I had used here 0.3785 and then used it to multiply 1.06 upon 1.052. So this comes out to be 0.3814. If I had taken this figure, 0.3785 into 1.06 divided by 1.052, then it would have been 0.3813137. So, okay, round off same thing. Fifth, 0.3814 multiplied by 1.06 and divided by 1.052. This is 0.3843. So first we will have to calculate the forward rates. Now we will have cash inflows year 0, 1, 2, 3, 4, 5. Cash flows in LKR, Sri Lankan currency, 25 billion, 5, 6, 7, 8, 9. Cash flow in Indian currency. So 25 into 0.37, 9.25 would be the outflow. 5 into 0.3728, 1.864, 6 into 0.3756, 2.2536, 7 into 0.3785, 2.6495, 8 multiplied by 0.3814, 3.0512, and 9 multiplied by 0.3843, 3.4587. PVIF factors at 8% because that's the required rate of return in India. 0.92593, 0.85734, 0.79383, 0.73503, and last 0.68058. So when you will now multiply these, you will find a present value, which could be a slightly different figure as compared to what we have calculated earlier. Taking till 4 decimals again. 2.6495 multiplied by 0.79383. I'm working in the reverse direction. 2.1033, 2.2536 multiplied by 0.85734, 1.9321, and 1.864 multiplied by 0.92593. It's 1.7259. And this will be minus 9.25 only. Now let's see what the NPV turns out to be. So 1.7259 plus 1.9321 plus 2.1033 plus 2.2427 and last 2.3695. So the present value of inflows is 10.3735 and outflow is 9.25. So the NPV is again positive, rupees in million, 1.1235 rupees. 1.1235 billion rupees. What was the previous answer? 1.1646. But when you look at the depreciating Indian currency, the present value has come down a bit. NPV has reduced by some fraction. Okay. So this is how you calculate the NPV of a project where the investment is made in a foreign country. The discount rates applicable for the two countries will be different. And the conversion has to be done if you are doing it in home currency using the risk-free rates as the basis for calculating the forward rates. We'll assume that interest rate parity holds good. So we used 8% discounting rate to calculate the present value when we were using the home currency approach. And when we were using the Lankan currency approach, we were using the discount rate at 7%. So first working note would be to calculate the discount rate applicable. So this is all. I just have a summary for you for the Forex questions in which you can calculate. So just have a screenshot of this if you can. If you have imports payable, it's a liability. And when you have a foreign currency payable, you can hedge using either buying the foreign currency forward or in money market, you can borrow the home currency and invest in foreign currency. If you are an exporter, you will have receivables, you will have asset. The foreign currency receivable means hedging. You can sell the foreign currency forwards, or in money market hedge, you can borrow the foreign currency and invest in home currency. In both these ways, you will be able to lock your future flows, whether inflow or outflow. Under the options, it gives you a right, but not an obligation. So if you have payables, you can use call option. You can buy call option. But if you have receivables, you can buy put options. Particularly if you are not sure that the currency can move in which direction, it is always better to go for option rather than locking your future payments through forward or future contracts. Money market is arbitrage based, where you borrow in one currency and invest in another. So it acts like a synthetic forward hedge. When covered interest rate parity holds good, the forward outcome of forward is exactly as your money market hedge. There will not be any difference. So thank you from my side. I think it will help you to revise these concepts and be able to attempt the questions which are presented in the paper. Thank you.
Thank you, madam. Am I audible?
Yes, sir, you are audible. Thank you.
Thank you, madam. Okay, student, madam, thank you very much for sparing your precious time and enlightening the student on this topic. So, with
Thank you,
student,
sir.
with this, we have come to the end of two chapters. That is chapter number 10 and chapter number
Right,
10 and chapter number 11.
right, sir.
So with I think you must have revised the same. So
Right, sir.
thank you, madam, for once again, and thank you, student, for your patient listening. Thank you very much.
Thank you,
Okay.
sir. Thank you, everyone. Bye.
Okay. Bye. Session.